Welcome to the Wavy Tunnel Module 5 Trading Live by Jody Samuels. Welcome to the Wavy Tunnel Trading Methodology, Module 5 entitled Trading Live. Thank you for taking the time to learn about a system which is timeless, applies to all traded markets and every market cycle. We hope you are enjoying this Elliott Wave method of recognizing and identifying trades called the Wavy Tunnel. In Modules 1 through 4 of the Wavy Tunnel course, you learned in detail about the 5 Wavy Tunnel trade setups that you can take at various points in the Elliott Wave cycle. We also introduced a trade management approach called the 3 Profiteers, which will help you remain balanced on the fear and greed continuum as you trade. The Wavy Tunnel is one of the best Fibonacci and Elliott Wave-based trading strategies that I have ever seen in my 30 years of trading. In this module, we will fine-tune entries by reviewing candlestick patterns, cover actual trade setups using proper money management, and do a top-down approach review. In Module 6, we will link Elliott Wave counts with the Wavy Tunnel and introduce Renko charts to reduce the noise from the candlesticks. In Module 5, the learning objects that we will cover include reversal candlestick patterns, Wavy Tunnel trade review, trade plan execution and documentation, overlaying the tunnel from 3 charts to 2 charts, and drilling down from the daily for better entry price to a 5-minute chart. Ralph Waldo Emerson had this to say about ambition and work. Without ambition, one starts nothing. Without work, one finishes nothing. The prize will not be sent to you. You have to win it. Congratulate yourselves for being here. You have ambition. What some of you are realizing, however, is if you do the work, the rewards are bountiful. You will win the prize. You will master a trading methodology that can reward you over and over again with the proper analysis and trade plan. I look forward to your trading success. In this module, we will review candlestick reversal patterns and learn how they can improve trade entry for the Wavy Tunnel setups. We will present actual Wavy Tunnel trade examples using the 3 Profiteers entry and exit methodology. We will also present how to overlay the tunnel from 3 time frames onto 2 charts. We will look at drilling down from a daily chart setup to an entry on a 5-minute chart. So now, continue picturing yourself riding the waves and cashing in on profits using the Wavy Tunnel for success. The Japanese have used candlesticks as a charting and analysis technique for centuries. Candlesticks mostly help pick tops and bottoms and are most powerful when they confirm a Western indicator. Candlestick patterns are psychological imprints of what traders are thinking at any given time. There are approximately 40 reversal candle patterns that vary from single candlesticks to groupings of up to 5 candlesticks. And today we will focus on a handful of the most common reversal candlestick patterns. This method was developed in Japan many centuries ago and basically provides the same information as bar charts. A candlestick or candle consists of a vertical rectangle and often a vertical line on top of the candle, called the wick or the upper shadow, and a vertical line below the candle, called the tail or the lower shadow. The rectangle itself is known as the body, which represents the pricing activity between the opening and the closing prices. If the opening price is higher than the closing price, the opening price is recorded at the top of the body and the closing price at the bottom. The candle is displayed in a solid red body. When the opening price is lower than the close, the opening price is recorded at the bottom of the body and the closing price at the top. The candle body is displayed with a solid blue body. The biggest advantage of using candlesticks is that they can make it easier to spot certain price patterns that may not be as apparent on other charts. The disadvantage, of course, is that candlesticks take up a lot more horizontal space, giving a smaller view of market activity. In this picture, which is the most bullish or bearish of these candles? You might say that one is the most bullish or bearish candle. and it is very bullish or bearish in a strong up or down trend. But in some cases, 4 on the left can be more bullish, and 5 on the right can be more bearish. In the case of 4 on the bull side, a battle was fought, and at one point the shorts were in control. By the end of the candle, the longs fought all the way back and actually brought the currency pair above the opening price. This candle, if located at the bottom of a downtrend, can potentially signal a reversal in the trend. The same is true for the sellers in 5 on the right. So what do these candles mean? Who is in charge? The value of using candlestick formations is that it allows us to know who is in charge. For example, with candlestick formation 1, with a large body and no shadows, it is clear who is in charge. A large blue body moving up means the buyers are in charge. A long red body moving down means the sellers are in charge. There is an interesting candlestick pattern that identifies a trend reversal, called the bullish or bearish engulfing pattern. At the top of the market, when you have this candle in red engulfing the previous body of the candle, that is called a bearish engulfing pattern. Candlestick 2 is often called a doji, which signifies indecision. No one is in charge. Candlestick 3 has a small body and a small trading range. Usually, when you have a number of small bodies in sequence, that signifies a reduction in volatility, which will soon be followed by an increase in movement outside of the trading range. Candlestick 4 is called a hammer at the bottom of the market, and it is a reversal pattern. Candlestick 5 is called a shooting star at market tops, also signaling a trend reversal. Candlesticks are another tool in the toolbox and should be used in conjunction with another indicator. You will soon see how appropriate it is to use candlesticks at market tops and bottoms for the wavy tunnel trade setups. Let's look at some examples of reversal candlestick patterns. This is an example of a bullish engulfing pattern. The market is in a definable downtrend. Candle 1 has a small red real body. Candle 2 reverses, where the green body completely engulfs the previous day's red body. A stronger signal occurs when the green body reversal candle engulfs 2 or more bodies. This is an example of a bearish engulfing pattern. The market is in a definable uptrend. Candle 1 has a small green body in an uptrend. Candle 2 reverses, where the red body completely engulfs the previous day's green body. A stronger signal occurs when the red reversal candle body engulfs 2 or more bodies. The bullish morning star pattern is a 3-candle reversal pattern, and this occurs at swing lows. Candle 1 has a tall red real body. Candle 2 has a small red or green body. Candle 3 closes at least 50% into the first real body and is a tall green candle. The bearish evening star pattern is a bearish 3-candle pattern at swing highs. Candle 1 has a tall green real body. Candle 2 has a small green or red real body. And candle 3 closes at least 50% into the first real body and is a tall red candle. Hammers and hanging men are also reversal candlestick patterns. They have small real bodies, in this case either black or white. Real bodies are near the high of the session with very long lower shadows, at least 2 to 3 times the height of the real body. A hammer appears at the bottom of the decline. The market is hammering out a base, and hanging man appears after an uptrend. The shooting star is a top reversal candle, just like the hanging man. However, it displays a long upper shadow, and its small real body is at or near the lows of the session. The Japanese say that the shooting star shows trouble overhead. Because of the bearish long upper shadow, we don't need as much bearish confirmation as we do with the hanging man. An inverted hammer occurs after a downtrend. Here are some examples of market reversal points with these candlestick reversal patterns: the hammer, the hanging man, and the shooting star. When you are looking for a PW and FG trade, notice the candlestick pattern. A long tail is a sure sign of a reversal, especially if it lines up with the PW. Even the 3 breakout trades might have nice reversal candlestick patterns on retracement to the wave. Take note. Let this knowledge help inform your trading decisions for entries and exits. We also have candlestick patterns which are called dojis, or patterns of indecision. They are characterized by equal open and closing prices. When the doji appears at a major trend line, channel, or key support or resistance, it is an indication of a potential reversal. Take note for dojis at the wave and the tunnel. In a perfect doji and long-legged doji, no one wins. It is a draw for buyers and sellers alike. With a dragonfly doji, buyers have taken control at market bottoms. With a gravestone doji, sellers have taken control at market tops. Here are some other reversal candlestick patterns that you can look up and study to add to your trading arsenal of candlestick patterns. For every bullish pattern, there is a bearish equivalent. So you might look up tweezer bottoms and tweezer tops, or piercing lines and dark cloud covers, bullish and bearish haramis, the tri-star, and the harami cross. This concludes the section on reversal candlestick patterns. In our wavy tunnel trade review, let's clarify the wavy tunnel trades by looking at the trend sequence once again. Wavy tunnel trades can be broken down into 2 types. 1, there are 3 setups for the trend following trades, and 2, there are 2 setups for the end of trend trades at points 0 and point T. Take note of the reversal candlestick patterns at point 0 and point T for the PW trades. Similarly, notice the candlestick patterns at the waves 2, 4, and B retracements to the wave and or the tunnel. These trades would be labeled breakout 1, breakout 2, or breakout 3 trades. As you know, wavy tunnel trade setups appear on all time frames because the market is fractal. Here is a review of the wavy tunnel setup on the 1-minute chart. You can find wavy tunnel trades on any time frame. This 1-minute chart shows a breakout 3 trade, a PW trade, and an FG trade. This is a beautiful setup. You can actually see the wave 3 and wave 5 with divergence, all within the same few hours in a day. Trade number 1 on the left is a breakout 3 trade for a wave 4 pullback to the wave. Notice how the awesome oscillator comes back to the 0 line and price comes back to the wave for a wave 5 sell. Notice also the bearish engulfing pattern at the end of the wave 4 pullback. Trade number 2 is a PW setup after wave 5 completes with awesome oscillator divergence. The PW trade is followed by trade number 3, which is a fill the gap trade to the tunnel. After a 5-wave move, one can at least expect a 3-wave correction. In this example, it is a zigzag where wave A or 1 trades up through the wave in 5 waves, followed by a 3-wave B retracement, finishing with a 5-wave C to the tunnel. This is the perfect trade setup. You can find wavy tunnel trades on any time frame. This is a 15-minute chart showing a breakout 1 trade and 3 additional opportunities to sell breakout 3 trades. Notice how price comes back to the 12 EMA filter each time, providing resistance for a sell. Also notice the reversal candlestick patterns at each sell point. On the first 2 breakout 3 trades, there are bearish engulfing patterns. On the third breakout 3 trade, you see a small bodied candle which could signal a reversal. It would be important to wait for another candle before taking a short trade on this third entry. The breakout 1 trade occurs when the wave crosses the tunnel, with strong red candles pushing below the filter to initiate the trade. Trade plan execution and documentation. This is an example of a trade plan for the wavy tunnel breakout 3 trade that one of my students, Juan Maldonado, put together using the FX Trader's Edge trade plan template. Theoretically, there are 5 trade plans for the wavy tunnel trades. However, it is up to the individual trader as to which of the 5 trades he or she feels most comfortable with. The sections of this document include the name of the trading system, chart setup, general rules, and entries and exits on the next slide. The name of the trading system is Breakout Trades 3 Retraced Back to the Wave. In the chart setup section, note markets traded, time of day for trading, time frames to analyze, and the indicators used on the charts. In the general rules section, write down rules which apply to you. What reminders do you need to stay on track? Feel free to use this as a starting point. The entries and exits sections provide instructions for entering a trade and exiting that trade. Thank you, Juan, for sharing your trade plan and some of your trades which follow. Trade plan execution and documentation. Trade number 1, Euro USD 15-minute. The 3 profiteers is used on this breakout 3 trade for a 5-wave move, or a wave 5 move. Since the PPA is 90 pips, the 3 Fibbo targets are 89, 55, and 34 pips. The stop loss is set above the wave as per the trade plan. Initially, the wave crosses the tunnel and a wave 4 sets up for an entry. For this 15-minute Euro USD trade, the 3 targets have been met, 89, 55, and 34 pips on a 15-minute entry. Note that the PPA can be determined by looking at a higher time frame, wave count, or support and resistance. Trade plan execution and documentation. Trade number 2, Euro USD 5-minute. On this breakout 3 trade, all 3 targets have been met from the 3 profiteers targets, 34, 21, and 13 pips on a 5-minute entry. Trade plan execution and documentation. Trade number 3, Euro USD 1-hour big picture. For this trade, a top-down approach is taken, looking at the hourly time frame first. Notice that the hourly chart is in the midst of a fill-the-gap trade to the tunnel. The PPA is taken at the 1-hour tunnel for a 40-pip profit target. Now we will look at the 5-minute chart to see how the trade was executed. The fill-the-gap trade on the hourly chart is a breakout 3 trade on the 5-minute chart on a wave 4 pullback for a wave 5 move. In this trade, the profit levels are 13, 21, and 34 pips based on the 40 pip potential profit area, or PPA. The first 2 targets, TP1 and TP2, for 13 and 21 pips are met. TP3 is stopped out in profit at TP1 for 13 pips. Trade plan execution and documentation. Trade number 4, Euro USD 1-hour big picture. This hourly chart is setting up as a breakout 1 trade on this time frame after a PWFG trade. The chart is labeled as a WXY correction for a wave 4, and we are in the final stages of this move. We will now look at the 15-minute chart to see how this trade presents on a smaller time frame. On this 15-minute chart, 34, 21, and 13 pips are entered for profit targets with a stop below the wave. This is a breakout 3 trade on this time frame. Let's see how the trade pans out. It looks like all profit targets were met upon completion of the wave 5 of C of wave Y for wave 4. That's a mouthful. And notice the next trade that sets up. Look at the divergence between the wave 3 and 5 of this corrective C wave and the PW, fill the gap, and breakout 1 trades which follow. Trade plan execution and documentation. Trade number 5, Euro USD 1-minute entry. This is our final example. This trade is a short position taken for a breakout 3 trade. Price retraces back to the wave and closes below the 12 EMA. The profit targets are 8, 13, and 21 pips. But notice the warning signs of triple divergence. Let's see what happens next. The trade gets stopped out. After the divergence, the market trades up to the wave for an A or 1, down for a B or 2, and up for a C or 3. Let's look at the bigger time frames on the next slide to see if we see any other clues that may have helped us before pulling the trigger on this sell trade. Sure enough, if we look at the 15-minute chart on the left, the price is already at the tunnel and the awesome oscillator is very stretched. Perhaps it needs to come back to the 0 line. On the 5-minute chart in the middle, the awesome oscillator is making its way back to the 0 line. Finally, the 1 minute on the right shows the triple divergence. We indeed had warning signs on all 3 time frames. In this next section, we will review the top-down approach and show how we can overlay the tunnel on more than one time frame at once. But first, let's review this daily chart of the Euro USD. On this chart, the Euro USD trades below the wave, tunnel, and filter for this downtrend. For this PW trade setup, we have divergence and a nice hammer for a reversal candlestick pattern. Focus in on this swing low for a daily PW trade as we move down to the 4-hour chart to see the setup on that time frame. You can see that the PW setup on the daily time frame is a 4-hour combo PWFG trade. A move to the wave on the daily is the same as a move to the tunnel on this 4-hour chart. Now let's look at the hourly chart to see the setup there, which will coincide with this fill the gap entry on the 4-hour chart. The 1-hour breakout 1 trade is the same as the 4-hour PWFG combo and the PW on the daily chart. The initial target on this breakout 1 trade is the 4-hour tunnel. The eventual target could be the daily tunnel. Now, how can we define targets without looking at the 3 time frames all the time? What if we put the daily tunnel on the 4-hour chart and the 4-hour tunnel on the 1-hour chart? Let's see what happens. Viewing 2 time frames on one chart, putting the 4-hour tunnel on the 1-hour chart. The tunnel consists of the 144 EMA and the 169 EMA. The number of hours in a 4-hour candle is 4. If we take 144 and 169 and multiply them by 4, we get 576 and 676 EMAs respectively. We then put these EMAs on this 1-hour chart. What you see here is a 1-hour chart with the equivalent of the 4-hour tunnel, as well as the regular 1-hour tunnel and wave. The breakout 1 trade on this hourly chart is pretty clear to see. What is even clearer is the 4-hour tunnel for the PPA, or potential profit area. Are you having an aha moment right now? How cool is that? You can certainly replicate this if you are a day trader using the 1-hour, 15-minute, and 5-minute charts for the top-down approach. It works the same way. Now we are going to switch gears and show you how you can spot a trade on the daily chart and drill down to a 5-minute time frame to take the trade with a smaller stop loss using the daily chart for the PPA. In this case, we are looking for a sell at the end of this wave C for an initial move to the wave. This would be considered a breakout 3 trade on the daily chart. I've noted the high prices of the 4 candles side by side at the tunnel resistance. First off, how remarkable is it that price stopped at the tunnel to begin with? The high prices are 134.86, 134.80, 134.72, and 134.86. The tunnel high is 134.60. Even though the tail of each candle goes above the tunnel, the closing price is either at the tunnel or below. Looking at the daily candles, the strategy would be to sell below the daily candle low at 133.89 with a stop above the high at 134.86, risking 100 pips. The reward is about 350 pips on this trade. Now let's illustrate what the 5-minute chart looks like for a better trade entry. Just note that you might have to stay up around the clock following the smaller time frames, as it took 4 days for price to finally break down. This is a 5-minute chart of the Euro USD on day 4. The day price finally broke down. Notice this beautiful setup with triple divergence. This setup occurred in the Asian session, with a third peak occurring at midnight New York time. The price high is 134.86, with an entry at 134.78, which is a fill the gap entry once price trades below the 12 EMA and the wave, and a stop at 134.89. This is an 11 pip risk trade for a 450 pip gain. In order to train the mind to take this kind of a trade with such a huge profit target, one needs to plan this trade on the daily chart and follow it on the daily chart after it is taken. It is too easy to take profits based on the 5-minute entry. One way to do it is to use the 3 profiteers for profit targets. From the daily chart PPA and the 5-minute entry, the PPA increases from 350 pips to 450 pips, because on the daily chart the stop is 100 pips, so we can add that back to the PPA now. Working backwards with the Fibonacci sequence from 450 pips, we come up with 377, 233, and 144 pips for profit targets. From an entry sell at 134.78, the 3 targets would be 133.34, 132.45, and 131.01. If you look back at the daily chart, you see that all 3 targets are met. Is this not a way to remove the thinking part of the emotions to just trigger the trade? This will take practice, as it is a mindset to look at a daily setup, take the trade on a smaller time frame, and keep the daily profit targets. But it certainly reduces the risk, enabling one to take a larger position. This concludes this section on drilling down. Concluding remarks. Here are some observations. When the wave and the tunnel come together on the 1-day chart, then a big move is about to happen. We are in equilibrium at that point, most likely in a quiet, consolidating, corrective pattern, and in the markets we don't stay that way for long. Look for a break. When the wave and the tunnel are separating, then the current wave is likely to be an impulse wave. Waves 1, 3, 5, A, or C. Look for breakout trades and join the trend. When the wave and the tunnel come together, then the current wave is likely to be a corrective wave. Waves 2, 4, or B. If there is divergence in the awesome oscillator, it could be the end of the trend trade. End of waves 5 or C. There are many ways to run with the wavy tunnel. From a swing perspective, use the 1 hour to take trades and the 4 hour and daily to confirm the setup and find the targets. From a day trading perspective, use the 5-minute or 1 minute for entry and look at the big picture on the 15-minute and the 1 hour to confirm the setup and find targets. A PW trade on the daily will almost always produce a fill the gap on the 4 hour and the breakout 1 on the hourly. A PW trade on the 1 hour will almost always produce a fill the gap on the 15-minute and a breakout 1 on the 5-minute charts. We have illustrated these setups. You also now know how to look for targets on the same chart by adding the tunnel from the higher time frame. Trade planning is key. Maintain organization in your trading life. Be consistent with documenting the trades and reviewing them weekly and monthly. Set goals for yourself. Money management is also key. Always calculate your position size. You are in the home stretch now. One more module. If you enjoyed this 10-module course, 4 Elliott Wave modules, and 6 Wavy Tunnel modules, and would like to write a testimonial, it would be most appreciated. Please email testimonials to jody@fxtradersedge.com. Thank you very much. See you at Module 6 of the Wavy Tunnel.